Maneesh Dangi joined just now, been changing notes on the good, bad, ugly, what will change medium term, long term, short term. But nothing changes for Maneesh Dangi because he's still joining us from the same place. Right, Manish? सब बदल सकता है मगर कुछ चीजें नहीं बदलती हैं.
Good morning, Nikunj. शाश्वत कुछ भी नहीं है.
Manish, I'll first address the behavior part. Very important, right? 2019 markets loved the verdict. 2014 markets loved the verdict. 2024 also looks like markets will be happy about the verdict. But in 14 and 19, the stock markets post the election verdict, even though they liked the verdict, they were down and returns were not that exciting. It turned out to be a case of buy the rumor and sell the news. So do you think this time also the same playbook could be at play? That the adjustment, excitement, short covering, everything will play out in today and tomorrow?
Nikunj, it is somewhat true only that these happy hours will last for only, maybe a few days, perhaps. But beyond that, business as usual will return. 2014 and 19 both. 19 actually was at least markets weren't as convinced. And therefore, sort of, in some sense, it was a positive surprise. And even then, actually, market didn't do as well as, I would have expected. For a variety of other reasons, of course. This time, market, as Pranju was saying, came in with full anticipation of these sort of results. And which is why, at least for equities, Nikunj, these business as usual would resume, barring, of course, few sectors, which could really do very well given the continuity that Modi regime provides.
Should we divide in asset classes or should we divide things in time frame? What is a better way of approaching financial assets now?
So Nikunj, again, I'll tell you from a, let's say, asset classes point of view, we talked about equity. But, a few people realize that, return of Modi actually is absolutely loved by bonds, because it sort of assures that this small risk of high fiscal deficit and potentially very high inflation has gone. Modi regime's policy have ensured that even in a growth such as what we are experiencing right now, core inflation is below 4%. So you would see more of it over the next few years. That means a sort of legitimately a secular and rather very big bull market can happen in bond markets over the next 3, 4, 5 years. So you will have a business cycle slowdown at some point in time, Nikunj, and I wouldn't be surprised if bonds actually sort of get down to levels of, let's say, even 5 for that matter, which, most bond market participants will scoff at, when I say this. But it's very likely it'll happen. From currency standpoint, Nikunj, it's our currency is relative to dollar, and of course, as it is the case with most currencies, it's very, very cheap, and therefore, yet again, for next many years, 3, 4, 5 years, you could have a very stable currency, so to say. Credit is absolutely great given the balance sheets of the country. If you're a venture capitalist, it's such a good news. I mean, over last 2 days, any good venture idea, had a circuit of sorts, even though it's not there in public equity. So, the implications across asset markets are different, but generally across financial assets is favorable.
If one assumes that bond markets will rally and bond yields will come down, then a very basic change happens, which is cost of capital in the system goes down. Cost of capital in the system goes down, that means financials will do well. Companies which have debt, they will do well. Operating leverage and financial leverage benefits would kick in. Are we in that kind of a scenario where disproportionate gains would be there in companies which are high debt companies, which are in financial sector per se, which are currently relying a lot on borrowing from the bond market and from the debt market?
Nikunj, I've been searching for firms which are very high debt firms now. So good 10 years of, teachings and promoters having gone bust have learned such hard lessons. It seems that no one wants to take leverage. So leverage has become such a bad word, and I hope this changes. because without leverage, how will you get growth beyond whatever we are seeing in last 1-2 years? So leverage is not there, and which is precisely why, of course, the firms which are low leverage are so far from bankruptcy, and yet borrowing at, let's say, 14-15% are great assets. But what does flow rates do? Effectively, of course, it benefits bonds, Nikunj. But please remember, and I think have talked about it to your audience many times, that real rates matter. The difference between bond yield and the potential inflation matters to PE ratios. People, who don't understand bond math, confuse as if nominal rates matter. So, you could have 10-year bond going to 5%, and yet, P ratios can shrink because the real rates have risen. And the classic case is, let's say, China, where the rates have plunged to 2% or thereabouts, and yet P's have actually fallen, not risen. So, would you have lower real rates in next 2-3 years? It would only coincide, Nikunj, with what do you call it, inflation very low, and therefore economic slowdown. So, it's unlikely that just a nominal real rates, which is a produce of low inflation in India in general, will result in higher P ratios. So that math, people have to understand. Just because bonds are rallying does not mean P's will actually go up.
And what's the outlook when it comes to the FII positioning? Which sectors do you believe that the FII flows will perhaps unwind via?
So FIs, of course, everyone by now, of course, knows how skewed the positioning has been, at least at margin, and that would unwind. Of course, they will return to their favorite sectors and favorite caps, which is why mega caps will do rather well. And within that, private sector banks, it's sort of easy to dial that risk because it at least on the face of it appear relatively cheaper vis-a-vis other constituents of Nifty or big market. So I guess this is where a little bit of a perk up can happen, where FIs who are short, actually burn their positions and sort of unwind their short positions.
Every government, in a sense, reboots new things and they extend what they've done in the past. And I'm just breaking this for our viewers, Maneesh, here, because if one looks at, let's say, Modi 1, there was renewed focus on digital India. Schemes like Jan Dhan, they were, in a sense, implemented. Similarly, in Modi 2.0, Atmanirbhar Bharat, defense, or perhaps PLI schemes were unleashed. So if you bought defense stocks in Modi first term, you did not make money. You made money in defense and in railways if you bought them in the second regime of Modi. What, to your mind, could be that new theme of Modi 3.0, which could be the big new focus area or the new policy thrust of the government?
So can I take a step back and sort of give you a broad picture of how Modi 3.0 would behave? Which 3.0 primarily will be very much like Modi 2.0, given the awesome, almost a comprehensive victory that the incumbents are having right now. I guess from a government standpoint, it's going to be even more technocratic than Modi 2.0, given the hegemony of Modi now. So in a sense, the role of MP to that extent in running the government would reduce even more, and technocrats, you'll see more Ashwinis and Rajivs of the world in the government, which perhaps at least in near term is a good news, because what we need, of course, now is better execution in many areas. From an RBI standpoint, you would very likely have digitized CBDCs, getting rolled out, and that actually will pinch sectors which have a lot of black money rotating. So therefore, more formalization could happen. That the tax evasion will reduce. I mean, I wouldn't be surprised, Nikon, that in next 3, 4, 5 years, CBDCs will become mainstay, and the 100 rupee and above notes, will get discontinued. Digitization of land records will happen from a again policy standpoint. It's going to be a very, very big push. And then, because the fiscal consolidation will happen, some of the areas which were actually getting a lot of benefits, would at margin worsen, because the next 5 years fiscal deficit very likely, Nikunj, will be about 4.5% versus last 5 years 6.5%. So the fiscal impulse in economy will slow. Therefore, sectors which are very close to benefit from government spending, outright spending, would at margin hurt. Whereas the private capex, most likely in core sectors, steel, cement, green energy, I think can go for a secular, significant bull market, in terms of boom rather, not bull market. And so those sectors, the picks and shovel businesses of related to those sectors will actually benefit. So I think Modi 3.0 is the imprints of them is already there in the market. The stuff that will do well. But I'm little, as I said in the beginning, that these happy hours, with respect to PSUs and all, may not sort of continue for long, given the valuation premium or the heft that they've built. So investors ought to be very careful about some of these themes.
One or two themes which in a sense needs to be addressed, and how can one really maximize on it? For example, climate change, pollution, energy transition. These are themes which in a sense will become more and more center stage now. Heat wave
Yes.
this year, well, government will have to do something next year. Pollution in cities, something needs to be done. Water problem in all the cities, it needs to be addressed. Do you think a lot of these small themes will start getting addressed now?
Yeah, but that area of investing is not in public equity because there is a lot of inefficiency in actually solving big ticket frontier problems through public equity markets. A big balance sheet, even if they're relatively agile, are not very good. Are very expensive to solve these critical problems. So the climate change problems, or anything to do with sort of more innovations. Even in US happens in ventures, the small ventures, so those are the areas, one of the asks that I'll have from a Modi government, if I had one, is that, or rather two, is that, have tax harmonization, and I didn't talk about it, but I think in equity markets won't like it. There will be tax harmonization between, not between fixed income and equity, but between equity and other riskier asset classes. You could call it VC and angel and many other forms. If that happens, a lot of HNI and family offices money will begin to flow into fund ventures in India, and that potentially will solve a lot of these problems that you are alluding to. Nikunj, so I guess, and the second, of course, is that the esteemed institution in India is so poorly funded. I hope that this government actually wakes up to this reality that they need a lot of funding, which is where a lot of these ventures will come from, and their infrastructure is creaking and it's in a very, very bad condition right now.
So, Manish, final question, and it's not a hypothetical question. I'm painting a realistic, scenario here. If a client walks to you on an advisory capacity and he says, "Look, I loved your interaction on ET now. I'm convinced the way you're thinking. Here's my check, which you're free to invest for next 3 to 5 years. I'm ready for a 10-15% downside. I don't care about what asset allocation you invest in, what leverage you do. I'm looking at absolute returns by end of it." So for somebody who gives you this, what we say, blank check, carte blanche, how would you invest in terms of a 15 to 20% volatility, but an absolute return, asset allocation? How would you do that?
If it's Nikunj and a rich dude, 10-15% of his money goes to alternates, which is sort of could be private debt, ventures, and stuff like that. 50 to 60%, of course, goes to public equity, primarily mega caps instead of small caps. If you're at a sectoral level, if you could deploy while that sector is high beta, the core sectors and defense would be priority, but private banks and large sectors would actually, of course, dominate given the weight in the index that they have. Given that the duration is likely to do very well, I would sort of sneak in long bonds, potentially even 30-year bonds, but primarily 10 to 15-year bond, because that would also deliver him 10-11%, and a very, very small money, Nikunj, 5% or thereabouts in cash. So that's how I would allocate the capital of Nikunj.
Manish, good chatting with you as always. Thanks very much for giving us the all-round view on how to look at the macros coupled with the elections and how the markets and liquidity situation is likely to flow as well. That's the take coming
you.
in from Maneesh Dangi. The FII flows could unwind via the private sector banks as well as the capex, and bond markets clearly cheering the return of Modi. Just a quick.
If you like this video, then like, share and subscribe to ET Now.